8 things the middle class consider as assets but are not. Welcome back to the channel WISGRAM, where you can get practical wisdom for money, investing, success, and more. In today's video, I'll be sharing the 8 things that the middle class consider as assets but are not. But before we begin, please give this video a big thumbs up and don't forget to subscribe so that you wouldn't miss any of our new videos that will be uploaded every week. Now, let's get started. An asset is described as generating cash flow, cutting costs, or increasing sales in the future. It is a resource of economic worth that is owned or controlled by a person, company, or country in the hope of bringing benefits in the future. So, it is extremely important to know exactly what assets are or what is a liability. With that in mind, what exactly are the things that the middle class consider as assets but are actually not? Number 1. Having a formal education. According to Forbes, Dell Technologies CEO Michael Dell dropped out of the University of Texas in his freshman year. Apple co-founder Steve Jobs once said that dropping out of Reed College was one of the best decisions he ever made. While the middle class believes that their investments in formal education are an asset and can determine their wealth, the rich know that it isn't the way things work in the financial world, because if that's the case, every summa cum laude graduate should be a multimillionaire by now. Learning how money works and how to make it work for you makes you rich. Well, academic training is important, especially if you want to become a teacher, a lawyer, or a doctor. But schools never teach how money works. They don't teach students how to invest or be self-sufficient. Instead, they teach them to be employees instead of their own bosses. Also, if you end up with a huge amount of student loans after graduation, education can definitely be a liability. Number 2. Owning a house. An asset is nothing more than a source of income. So-called financial experts can use a variety of accounting tricks to make items that aren't assets appear to be assets, which can be useful in some instances. However, in the real world, where you need money to survive, if you have a property that you live in, whether paid for or not, it isn't an asset. This is especially true if you don't own your home yet. Then it becomes the bank's asset, and it serves them. You pay bank interest each month on top of the equity you put into the house through your mortgage. It makes a lot of money for the bank, but it doesn't make any money for you unless you sell the house. Many people understood that appreciation, or the difference between what you paid for and what you can get for it, is not guaranteed amid the Great Recession. They lost everything when the value of their houses dropped below what they had paid. Then, the house was an absolute liability. Number 3. Getting a job. The middle class is conditioned and taught to become employees. They commit to jobs they consider acceptable and stay with them for years while worried about being fired or dreaming about the day they can finally retire. Thus, getting a job is a liability because first, it's not an asset if you work for someone else. And second, a job doesn't guarantee financial security. Those who become wealthy abandon this way of thinking and become entrepreneurs. Having a business is the real definition of an asset. So, what's the best way to make that break? First, you need to increase your financial literacy and start thinking like an entrepreneur rather than a worker. When you do that, you'll finally understand that everything you've been told about getting a job and pursuing happiness through employment is a lie. Most successful people concentrate on the profession they enjoy, pour their hearts and souls into it, and rise to the top in their field. And that's when they are rewarded with uncommon wealth. Number 4. Keeping a car. One of the most typical mistakes made by car buyers is misclassifying their vehicle as an asset when it is in fact a liability. While it is easy to argue that vehicles are assets since they can return a reasonable amount of money when sold, this is rarely the case. A vehicle is not usually categorized as an asset despite it being a liquefiable investment when sold because of the hidden cost of owning it. These costs include fuel, repair and maintenance, registration, sales tax, insurance, and toll fees. Also, automobiles are famous for losing a significant portion of their value as soon as they leave the dealer's lot. According to the US News and World Report, the average new car can depreciate by as much as 30% in the first year, with each subsequent year marking another 15% to 18% in value lost. So, if an asset is anything that has value, how can a car be considered as one? Furthermore, automobiles are susceptible to various depreciating conditions that can cause their values to drop dramatically. It is therefore an extensive liability. Number 6. Saving money. When the United States went off the gold standard, the dollar ceased to be money and became a currency. Money is a commodity that retains its worth over time. However, the currency's value fluctuates, and the US dollar has been losing value since 1971. Today, the bank pays you a lower interest rate on your savings than inflation. In other words, your money in the bank loses more value than it gains. Thus, focusing solely on saving money is the secret downfall of most people. Moreover, a savings account is subject to charges by your financial institutions. The fees are frequently very similar to the so-called interest that your money accumulates over time. Therefore, a savings account is not the best choice for you if you want to start a project, get out of debt, escalate money for a future purchase, or if your dream is to simply become wealthy. Because interest rates are so low, the rewards on your money are insignificant. Some banks even provide interest rates of less than 1% per year. Therefore, analyzing the reality, your savings account yields interest over time, but that interest is taken away by your bank by imposing charges, making a little to no difference to the original amount. In addition, withdrawals from your savings account must stay within federal limits. Federal restrictions on savings accounts mean that you can't withdraw more than a particular amount from your account in a given month. The fact that you can only withdraw a certain amount of money from your savings account is a significant liability. Number 7. Investing in the long run. If the previous recession taught us anything, it's that nothing is guaranteed. That includes all long-term investments such as mutual funds, stocks, and bonds. In comparison to trading, investing tends to reuse capital less frequently, resulting in lower annual returns than those observed by a competent trader. It can also be difficult for investors to outperform the market. Long-term investing lowers your investment risk by eliminating missed opportunities. Trying to dive in and out of the market at just the right time could result in your missing big up days in the market. Plus, you won't be able to withdraw money whenever you need it, since you must wait for the market to mature before deciding. It is also of high consideration that investments require fees to be paid for trading and keeping your stocks. There is also the risk of having less control over your money due to the long period for the stock to mature. Number 8. Getting out of debt. The idea that you must get out of debt and stay out of debt to be successful is a fiction that is repeated because people don't have a financial education. The wealthy are in debt. They are usually in a lot of debt. They do, however, have assets that far outweigh their debt. In fact, the wealthy carry debt and actively use it to increase their wealth. The rich understand the difference between good debt and bad debt when it comes to debt. Bad debt is the type of debt used to buy liabilities. Good debt is debt that makes you richer, such as a loan for an investment property or to purchase equipment for your business that will make you a return. This is the type of debt that is used to buy assets. So, what liabilities do you have that you have considered as assets until now? What assets will you focus on building from now on? I hope there are many takeaways from today's video for your rich journey. Please leave us some comments below. Well, that's it for today. Thank you for watching and see you again soon in another one of our episodes. Once again, if you like this video, please give it a thumbs up and share it with your friends and family so that they can enjoy it as well. With that said, have a wonderful day everyone, and I'll see you in the next one.